So again, welcome everybody. We'll be starting in a minute. Just getting all the participants in. Thank you. Okay, great. Let's make a start. And again, I want to welcome everybody for able to join us today for our Kuwait continuing webinars that we are having at KPMG Kuwait on the tax matters. And in this session as well, that is, we're going to discuss obviously the adjustments that are under the executive rules. I think we picked on quite a few of them in the last few of the webinars that we did. So what we're going to do today is continue that, and obviously we are looking at some of the executive regulations which are very critical in the sense of the management fee impact, the impact on the because of the royalties, what happens over there, license fee, and again losses carry forward. So quite a lot of interesting um, information to obviously. Again, just to say, introduce myself. I'm Zubair Patel. I'm the head of tax at KPMG in Kuwait. I'll be joined by some of my colleagues, which I will introduce you um, in a short while. Obviously, if, Misbah, if you can go on to the next slide. So we just set out some of the rules in terms of the what we're going to do. Yeah. Okay, thank you very much. So as you can see, I think we have got this session plan, which is for the next 45 minutes. I think we'll be talking about and providing our pragmatic and practical input, um, based on our experience and the experience of my colleagues. Obviously, we will, as we get questions, we will obviously pick on the important one, but we'll try to save 10 minutes for Q&A. But we'll try to make this as sort of interactive as possible. Obviously, you can use the chat function to ask questions. And where we are not able to respond due to any time constraints, what we'll do is we'll reach out to you following the session. If you could just leave your details. The session is being recorded and will be shared on our social media channels. I'm sure that you've seen that. We've shared that on our YouTube and other channels. So again, you could go back and access it when required. And as usual, I think these are all KPMG copyright, and hence I think should only be used by anybody after the consent of KPMG Kuwait. So let me now go on to the next slide, which sets out who are the speakers that would be joining in with me. So obviously I've already introduced myself, so I wouldn't do that again. But of course, you have met in the past Fahim Bashir, who is again a partner at our tax and corporate services at KPMG in Kuwait. Anan, you've obviously seen in our previous seminars. He's a director with us. Naveen couldn't join us today as he was traveling. So we have the actual pleasure to having Hiba on board with us. Hiba is a very experienced manager with us and also deals with all the TIT matters. So great to have Hiba on board here. So I think again with this team, we'll be going through these executive regulations and so if you go to the next slide, I think before I hand to Fahim. Yeah, if you go one slide back. So I think the background of Kuwait tax law, obviously, we've gone through, but can I invite Fahim maybe to summarize that for our listeners? So then, we can then start the discussions on the executive regulations. So over to you, Fahim. Thank you.
Hi, good afternoon, good morning, everybody. I hope Hope everybody is well, and thanks again for joining us in this continuing series of Kuwait Tax webinars. As introduced by Zubair, what we'll do to begin with, and has been the practice, that we will go through some of the general background to the Kuwait tax environment, just to catch, just as a recap, and then set the scene a little bit before we dive into some of the detailed executive regulations that we'll be covering today. In terms of the Kuwait tax environment, we have a very broad tax law, corporate income tax law, which imposes 15% corporate income tax on foreign companies earning income of a Kuwait source. Now, the tax law does not define permanent establishment like other jurisdictions. It talks more about contracts wholly and partially executed in Kuwait being subject to tax in Kuwait. And that is applied by the tax authority quite aggressively, and even a single day's visit in Kuwait related to a contract would then consider that entire contract taxable. We've spoken about the application of tax treaties in the past webinars. Please refer to those earlier sessions where we talked in quite detail about exclusion of income from Kuwait tax based on tax treaties. But typically, what Kuwait would do in the absence of a tax treaty is consider the full contract value as taxable. There are specific provisions regarding royalties and license fees within the domestic law, and those irrespective of physical presence tax in Kuwait. And we'll be going in a bit more detail on the basis of taxation of royalties and license fees in the later slide. Once a taxable presence has been created, all your Kuwait source income is reportable in your return, in the consolidated return for the foreign entity. The other aspect, which is important and a bit different from other jurisdictions, foreign shareholders in Kuwaiti companies are subject to corporate income tax through filing of a tax return. So there's no tax on dividend distribution, but foreign shareholders would pay tax on their share of profit of the operating Kuwaiti entity. And again, that is an unusual aspect of Kuwait, where compliance flows up to foreign shareholders rather than at the local entity level. Withholding taxes are not applicable in Kuwait. We have, however, the retention regulations, which require contract owners to deduct 5% of payments to companies until a no objection letter or tax certificate has been issued by the tax authority and allows that release of retention. And obviously, non-compliance with respect to retention can lead to significant disallowances of related costs in your assessments. So it is always an area of scrutiny, and robust documentation is always advised when demonstrating compliance with 5% retention. So next slide, please, Mr. Yeah. So setting the scene a little bit further. So today we are exploring again the executive rules. We'll go through, I think, 5 or 6 of them in quite detail. Of course, the executive rules are focused around the adjustments and the cost reductions in return. The law requires taxpayers to file on an actual basis, which is basically on your taxable profit P&L basis. There is, of course, in practice, the deemed profit route, and when we talk about the executive rules today, the deemed profit route is alluded to in the executive rules, although not formally provided for in the law. The executive rules cover certain scenarios where deemed profit is applicable and the basis of taxation in that respect. We will go through that. When you're filing on actual basis, the key point and a lot of time and effort is required at the annual tax inspection stage. So each year, every taxpayer for every year is audited. The tax authority look at revenue and costs through supporting documentation, and that is where it's important to have robust documentation and accounting systems which can capture the level of documentation that the tax authority requires on an annual basis. Our focus in these sessions has been the codified adjustment, whether that's in the executive bylaws or the executive rules, and those are the key areas of focus in the tax inspections as well. Now, when we support clients preparing their returns, we also look to align adjustments within the returns to the executive rule so that at least if the assessment is as close to the executive rule as can be. Uh, the other type of adjustment then that is left is the arbitrary adjustments that are not codified and that are very common indeed. That then are the main discussion point with the tax authority during the inspection stage. So as I said, we'll go through for around 5 or 6 of the executive rules in a bit of detail. I'll hand over to Hiba now, who will kick things off with talking about reimbursed expenses and Executive Rule 41. So Hiba, if you could take it forward. Thank you.
And before Hiba, you start, can I just remind all our participants if you could just keep your mics muted, because at times it just uh, creates, I think, the voice of the speaker to be a bit muffled. So really appreciate that. So over to you, Hiba. Thank you.
Thank you, Zubair. Thank you, Fahim. Hi, everyone. So we will start going through some of the executive roles, as Fahim mentioned, in little bit more details. We will start with executive role number 41. So this executive role is related to the reimbursable of expenses. As you are aware that the taxpayers in Kuwait, they are filing their tax declarations. They have two ways for filing tax declaration, either on deemed profit basis or on actual basis. Now, for the deemed profit basis filing, in relation to the reimbursable expenses, there are certain conditions where the Kuwait Tax Authority will be accepting the reimbursable cost if these conditions has been already achieved. One of them, it should be like the elements of the contract where the reimbursable is, which is reimbursable in nature. It should be clearly having the reimbursable clause, which is already stated there in the contract. And the reimbursable cost, it should be something which is essential actually for performing the full contract. This is another thing which is very important. The reimbursable revenue or cost should not exceed 30% of the gross revenue of that particular contract. And of course, there should be where the 30% actually reimbursement cost, where the reimbursement cost exceeded the 30%, then the taxpayer should be filing their tax declaration on actual basis. Or alternatively, the excess revenue will be subject to deemed profit, which is above on top of the 30%. Of course, supporting documents should be maintained properly and and available to be verified by the tax inspector during the inspection stage. Without these conditions, the tax inspectors wouldn't allow the deduction of the reimbursable cost, from the reimbursable revenue, during the inspection stage, and they will be adding this back to the taxable income. In relation to the actual basis filing, as we said, where the reimbursable cost it's exceeding 30%, then the taxpayer preferable to go on actual basis in order for the Kuwait Tax Authority to allow such reimbursable revenue. And for the calculation of the head office allowance, the reimbursed revenue it should be deducted before the computation of the head office overhead allowance. Of course, there are some practical challenges which we have seen during the inspections and during attending the inspection meetings for both types of filing basis. And one of them, it's the most important, I would say the most important one is the documentation, because the documentation, it should be always being available and ready to be presented to the tax inspector to match the reimbursed revenue and the related cost. And the other point that if the reimbursable revenue it's having any markup pass through the cost, so it will likely the deemed profit will be imposed on that reimbursable revenue, because it shouldn't be one of the conditions that it should be net when you are reimbursing the cost. It should be on cost basis without without adding any markup to this.
I think, Hiba, one of the questions that is coming on this, and I think a lot of the companies obviously they sign a contract and the reimbursable costs are not in the contract. So what is the other options available? Is there any alternatives by maybe stating that in the invoices, or because specifically it happens more which I think some of the question is in a government contract where they do not allow this to be documented at times. So what are the options available? I know that, the best option, as you highlighted, is to put it in the contract. But if supposing your contract owner doesn't allow you, then any other options available to create a better defense?
Yeah, Zubair, as you mentioned, like, okay, the mentioning the reimbursable clause in the contract, it's a very essential point as requested by the Kuwait Tax Authority and stated in the executive rule. But we have seen from the practice as well that when the taxpayer is able to prove that such reimbursable cost has been, it's just like made on cost by cost basis, and it doesn't have any markup, and this can be through adding it to the invoices and through the confirmation of revenue letter obtained from the local contractor also in Kuwait. We have been seeing cases, it was success in accepting, like, the reimbursable cost through having this stated in the invoices, which has been issued by the taxpayer, and also it has been stated in the confirmation of revenue letter from the local contractor in Kuwait.
Thanks, Eva. No, I think it's obviously the best option is to have it in the contract, but at least in a worst case scenario, there are steps you can take to try to, create some defense. Yeah, thank you.
Thank you. Now we will be moving to the next executive role, which is executive role number 42. This is in relation to disregarding books and records. Just in the beginning, we didn't see many actually of this case happening on the tax filing basis, like, for the accounts, because mostly, like, of course, if the company decided to go on actual basis, they should be maintaining their records and books, like, properly in a most robust manner. So actually, the executive role, there are specific circumstances where, like, the Kuwait Tax Authority will just, like, disregard the books and records, and they may go further and issue the tax assessment based on deemed profit basis. So they will not accept any of the costs reported in the tax declaration, and then they will assess the tax payer based on deemed profit. And these, like, circumstances, it's include, like, as we said, like, where the account books and records are not maintained properly and not in a robust manner, where, like, the supporting documents not presented to the tax inspector on time. So usually we are scheduling a meeting with the tax inspector in order to select the samples and then for verification of those samples. But sometimes, like, we see the taxpayers, they could get busy and they don't come back on time to the tax inspector for providing the supporting documents for the sample selected. So at that time, the tax inspector will be issuing a first letter for commencing the tax inspection. That letter, it's just like a first warning, let us say, for commencing the tax inspection and start providing the supporting documents. Where the taxpayer fails to provide the supporting documents, another letter, formal letter, will be issued by the tax inspector. And after the second letter, within certain periods specified in the letter, if the taxpayer didn't provide the supporting documents, the Kuwait Tax Authority may just go ahead and disregard the books, disregard the costs, and just, like, assess the taxpayer on the profit basis. Another case where the tax returns, when the taxpayer filing their tax returns with the Kuwait Tax Authority, there are certain required attachments. It should be submitted together with the declaration. This is according to the executive bylaw number Article 13 of the executive bylaw. And this includes, of course, the audited financial statements, trial balance of the final figures stated in the financial statements, list of inventory, list of subcontractors, fixed asset register, and the depreciation, the percentage of the depreciation. There are certain attachments which should be attached together with the tax declaration. And failure to submit these requirements or fulfill with these requirements, the Kuwait Tax Authority, again, they do have the right to disregard the books and the records. And discovering another circumstances which you may face, like, when there is a discovery of material unreported revenue. This could be, like, happen. I know it rarely happens. Actually, we don't see this regularly, but in case if there is any unreported revenue, which is a material amount, then the Kuwait Tax Authority can just go ahead and disregard the cost and assess this on the profit. So these are the circumstances where the Kuwait Tax Authority has the right just to disregard the books. And there are some practical challenges actually on this side. First of all, the subjective nature of the requirements above. Some of the requirements you can find like it differ actually from tax inspector to tax inspector, but at the end like all of them they have the similar requirements according to the executive rules and regulations, but it depends, for example, on the time or flexibility for giving the time in order to present those documents, which again is taking us to the second practical challenge that the Kuwait Tax Authority may request the documents on a short notice frame due to tough deadline, due to schedule, which they do already have, and a plan they do already have at the Kuwait Tax Authority, which may not match with the plan of the client. Because of course we understand that the client they do may have quarters closure, they may have monthly closure, and during these periods it's a little bit tough actually for providing and like the supporting documents, reviewing and providing all of them within such short notice. Although we are trying actually with the tax inspector to give more notice before issuing the letters, or at least like to be patient a little bit with the clients and explaining to them, but in this particular area there were like there should be like ongoing communication with the tax inspector, making sure that we are on the same page. They understand that the client may be having some ongoing work and they will not be able to provide it now. But again, this requires a cooperation between the client and the tax advisor, definitely, and the tax inspector, just like, to make sure that it's clear message. So if the taxpayer is busy and they will not be able to provide the documents, at least we should be providing, communicating the tax inspector that there is a certain time frame where we will be providing these documents. So Hanan, Fahim, Zubair, you want to add anything to this?
I think that that's a good point. As you said, the coordination with the tax authority and making sure the communication lines are open through us as tax advisors here, and that really helps the situation. And of course, we have seen it and heard of it happening, and it is a sort of from a tax perspective not something desirable to go being assessed on deemed profit when you have books of account. So definitely an area where clients should be mindful of from a coordination and requirements perspective. If I'm just conscious of time, I think we can move on to the royalties line. Yeah.
Okay, so we are moving to the executive rule number 44 for the royalties and license income. The computation of tax for royalties and license income, it's taxed at 98.5% after deducting the 1.5%, which is head office overhead allowance. Of course, professional fees in relation to tax compliance, it may be tax deductible as well. And we have seen like the Kuwait Tax Authority accepting this. And the above cost, it wouldn't be allowed by the Kuwait Tax Authority unless the taxpayer filed their tax declaration. And like where the Kuwait Tax Authority directly issued the tax assessment without the taxpayer filed the declaration, they wouldn't consider these like costs as a head office overhead cost or the professional fees. Of course, like we know that there is avoidance of double taxation treaties where like they provided certain benefits. It depends from country to country and depends from treaty to treaty. But yeah, in some of the cases, like we can see a reduced tax rate. We can see even some of the treaties they don't have a specific tax rate there for the realities, and this where like it's taking us to the practical challenges from what we have seen with the Kuwait Tax Authority, like in some of the treaties provisions has been like challenged by the Kuwait Tax Authority. And the most common one which we are working on it now, like, and we are trying to get it sorted out together with the Kuwait Tax Authority, it's Kuwait French Treaty. Like because the French treaty doesn't specify the reality percentage, or in particular the income should be taxed in the country where the company they do have their permanent establishment. So in most of the cases it's France, because the reality is just like giving the license. They don't do visits or regular visits to Kuwait which create their permanent establishment, but the Kuwait Tax Authority is still not accepting that basis, like for not taxing the reality income in Kuwait. Again, deemed reality, where like the contract does not specify the reality percentage between the contract owner and the taxpayer. There is another challenge, like from the Ministry to finance because they can just deem a royalty based on similar line of business, or it could be even higher. If the taxpayer didn't file the declaration at all, then the Kuwait Tax Authority may just assess the sales or whatever basis for the for calculation of the royalty on a very higher rate, which we have seen, and just like issue an arbitrary tax assessment in this case. The last one, it's the license on software and bonded software. So the license itself, it should be taxed at 98.5%, and after claiming the tax compliance cost. But when the license is bundled with or having a software and services, then they, just like the Kuwait Tax Authority, is going to impose it like on calculate the tax based on the profit basis. So
Can I just add, Hiba? I think just for, and I think some of the questions that have come through on this. I think the bundle software question is, it's not like one fit all solution. I think we'll have to review the contracts on that, because I think the ideally, which I've seen this working on a practical basis, and I think Hanan may also have some ideas on that, so can input in. I think if you have a bundle software position, but you are referring to license very clearly in those agreements, then I think it is at times better to you know specifically set out what is the fee attributable to the use of license clearly in the contract. But if it is actually a full bundle service, and effectively it's a very negligible amount, but I think it's very, very critical that we look at this cost, because obviously you are looking at a 14.77, nearly 15% cost on revenue versus a 4.5% cost on revenue. So I think this is definitely a lot of discussions we have been having, and I think Hanan, you think on a practical basis, this is a challenge we are seeing more and more coming through. Yeah.
Yes, Zubair, I think this is one of the key area where taxpayers they need to provide clear details in the contract. Because if it is a bundle package, there is a risk that tax authorities may treat this as overall license income and all. So I think as Hiba also highlighted, the contract should be very clear, and then there should be a separate articles where the fee is clearly mentioned. Otherwise, the risk will be there to have a, as you mentioned, that as a bundle they will be treated overall on 98.5% specifically, where there is no double taxation treaty available.
Yeah, these are all very, very detailed areas of discussions around treaty and use of treaties in those specific cases. But in the interest of time, maybe we can pick it up in a very specific seminar. Yeah. So I think that's one of the practical challenge that I've seen, and I think some of the questions that are coming through are also on in this particular areas. Yeah.
yeah,
I
thank
think
you,
we
Zubair.
can answer if there is specific questions on this area. I think maybe participant can send us email and we can
Yeah.
definitely have a look and answer them.
Yes, for sure. Thanks.
Yeah, thank you, Zubair.
Hanan, you can take, yeah, I
Yeah.
think Hanan, you
Yeah,
can
sure.
now move on to the rest of the slides. Great.
Sure, sure. Ms. Ba, can you please move to next slide? Yeah. Uh, this executive rule is specifically on management fee, which is typically taxed as 100% profit and 15% tax. And there is no cost deductions available against that, where management fee is charged by a Kuwaiti company to a Kuwaiti company by a foreign shareholder. In this case, this will be fully allowed if a foreign company is offering this management fee in their tax return. So this is one of the thing that make sure that if a foreign company is charging management fee to a Kuwaiti company, this should be also reflected in their tax return. So practical challenges on this is that sometimes the management fee includes certain regional sports services, which is not part of management fee, but because the contract is uh, overall contract is highlighting all the sports services, including other areas, some engineering. Sometimes we have seen that some engineering related allocated cost is also included in the same agreement. So the risk is that this will be overall considered as a management fee and will be taxed at 15%, or it will be added back to the foreign companies' profits if they are participating in Kuwaiti companies. So this should be looked in detail while finalizing the agreement with the Kuwaiti company or with any entity in Kuwait. There was another practical challenge which we have seen that the foreign company which is participating in with the Kuwaiti company, they have a separate shareholding, but the management fee is signed by another related party. So this can create overall you can say the burden to have a separate uh, entity filing a tax return in Kuwait, although that in principle all the management fee is charged by the same principal. So this can also to be looked while preparing or finalizing the management fee agreement with the Kuwaiti companies. So typically, we have seen also, the practical challenge that sometimes companies, foreign groups are charging management fee to the local Kuwaiti company, but in sport of that, there will be some management services or some management people will be provided on ground to that Kuwaiti company. So certain cost will be incurring in Kuwait, but as this is not part of Kuwaiti company cost, it is not part of the financial statements. So in order not to allocate this management related cost to Kuwait operations, this can also create a taxability, and especially when there is a management fee very quite material amount, then this will be added back to the profits of the foreign company, and this cost which is actually incurred on ground in Kuwait will not be uh, allowed as a chargeable expense. So what we suggest that while finalizing the tax return, if there is any allocated cost which is related to Kuwait operations, this should be reflected in a taxpayer's tax return in order to have avoid the dispute at the time of tax assessment. So, Misbah, can you move to next executive rule, please? Executive rule number 46 talks about carry forward losses. So carry forward losses, as you can see in the executive rule, it's allowed to be carry forward up to 3 financial years. Um, but there are certain limitations on that where carry forward losses will not be allowed to be carry forward for subsequent years, where a company is may cease the operation, then this carry forward losses will not be allowed for any future returns or any assessments provided by tax authorities for the subsequent years. In case where company is planning to liquidate or maybe have legal changes in the entity, or maybe there is a merger happened with another group. In this case as well, the carry forward losses approved by tax authorities to the specific taxpayer will not be allowed to carry forward uh, for the subsequent years. Practical challenges in that is that this should be maintained properly in your tax returns. Whatever losses are approved by tax authorities will be considered in your final tax assessment. It will not be allowed as part of your tax returns because this should be also subject to tax audit or tax inspection by tax authorities. So whatever you are reporting as a financial losses in your tax returns is not fully allowed until it is assessed by tax authorities. So all the tax calculation should be done based on the approved losses instead of going for the tax declaration losses. We have, I think, two examples. Misbah, maybe you can go to next slide where we have provided details. Maybe you can go to next slide. So we have two you can say that examples just to share with you that where a company has carry forward losses and losses are exceeding realized profit, or the profits are more than the carry forward losses. So how this should be reflected in your tax returns. So we have a case where you can see that there is approved losses of 500,000 by tax authorities. Then in next 3 subsequent years, the company is reporting around 400,000 profit margin. So first year they have a profit of 200K, second year 100K, and third year 100K. So on the first financial year where the company is submitting their tax returns, so you can see that 500,000 will be reported as approved losses, and then 200,000 profit should be adjusted with these losses, and the remaining carry forward losses will be transferred to subsequent years. In second year, the same remaining carry forward losses will be considered Again, considering that there should be approved losses from tax authorities, but in your tax return, you can reflect the same until the final profit is approved by the tax authorities. So 300K remaining will be adjusted with second year's 100K profit, and the remaining 200K can be carried forward to the third financial year. So you can see the same in the third subsequent years, 200K remaining loss will be adjusted with third year losses. But the last 100K, which is approved loss by tax authorities, it will not be allowed to carry forward to fourth year, as there is a limitation in the executive rule for 3 years carry forward losses. Another example, maybe Misbah, you can move to next slide, please. Yeah. In second example, we are saying where the profits are more than the approved losses within the three financial carry forward or subsequent years for approved carry forward losses. The same example, 500,000 losses we have approved by tax authorities, but the profit margins are high, and we are seeing around 550,000 will be approximately profits incurred in the next subsequent 3 years. So in this case, you can see in first year it will be the same 200K will be adjusted. In second year, we have 300 carry forward losses and adjustment of 250,000 second year's profits, where remaining 50,000 is carry forward to third uh, financial year. But in third financial year, there is profits of 100K. It means that the profit is more than the carry forward losses. In this case, the remaining, net profits will be taxed on 15%, and the taxpayer will be required to settle the taxes on the remaining profit after adjustment of carry forward losses. So this is the example for you to understand how you should be reflecting this as a taxpayer in tax returns and how tax authorities treat that. Yeah. So on carry forward losses, sorry, go ahead, Zubair.
Yeah, Hanan, one of the questions people ask is that, and I think maybe this example gives a summary that if you're not assessed for example, 3 to 4 years, and you have been obviously carrying forward losses based on your financials, and your inspection happens and there is a mass adjustment, and obviously those losses change to profit.
Profits.
So for example, we are looking at a 2017, and then the actual tax liability for 18 and 19 may be created. So are there any penalties? Because obviously a loss converted into a profit after the inspection. So should the tax have been paid for 18 or 19, or no? I think at that point you're required to pay the additional tax at the point where, say, the 2016 loss uh, was reversed in the assessment.
Yeah, this is really a good question, Zubair, because normally companies not look into that. And once we have approved assessment from tax authorities, whatever carry forward losses for subsequent years are not applicable, then the company is required to submit the approved taxes, whatever the tax calculations will be, based on the profits reported in that subsequent years, where the carry forward losses will not be applicable now. Within 30 days, they are required to settle these taxes in order to avoid penalties on this additional taxes amount. Because in principle, as per the tax return, they are reporting profits, and carry forward losses are adjusted until this is not approved by tax authorities. Where we have approved tax assessment and it is clear that this carry forward losses are not available to adjust with certain profits, then this will become a taxable tax returns, and within 30 days of this approved losses, companies need to submit their taxes for the subsequent years as well. Yes, so where this answer your question, or can we move
Yes,
to
and I
next
think
slide?
that's the question that is coming through from quite a lot of people. So I think, yeah, I think it's an area of concern, on the
And
delay penalties, etc., that
and
may
this is
arise.
very normal. We have seen companies, they once they're finalizing the tax assessment, they don't consider the subsequent year's impact, and which result into delay penalties. This is a very
Exactly.
important point, Subhair. I
I
agree
think
with you.
the bigger issue that is happening, which I think useful for the participants, is that I think good to go to your consultant and check, what are the potential exposures for future, because if you're going to make a tax provision in your financial statements, it needs to be, again, under IFRS, looking at the probable versus possible scenarios. So I think an area to consider, particularly if you have certain items, which could be subject to disallowances, because that could have a material impact on financial statements if it reverses out. And the second is because if you have not set out cash to pay this additional liability, you might end up um, looking at the whole commercial aspect of that. So I think good to be at least prepared so you manage your leadership discussion at an early stage. Thank you.
I agree with you, Zubair. I think this should be considered,
Yeah,
and
thanks.
advanced planning will always help. Mispa, can we move to next slide, please? Yeah, this executive rule talk about related party transactions. First of all, it should be the requirement is that it should be on sound basis. Unfortunately, we don't have certain regulations where uh, there's transfer pricing regulations or all are available on the allocation of certain transactions. But this uh, specific regulations talk about that whenever transactions are happening with a related party, first of all, it should be on fair market value and on sound basis. And this normally is considered and also compare with the unrelated third parties that is on the similar basis, and wherever there is uh, certain amounts which is not in line with the requirements of tax authorities or certain documentation are not properly maintained, tax authorities normally disallow certain related party costs on arbitrary basis. So law does not provide a fixed percentage on the disallowances, but based on the documentation, we have seen that this disallowances are from 15 to sometimes on EPC contracts, we have seen up to 50% as well. Fahim, you want to add something on that?
That this is the one of the biggest challenges is that it's not codified. It's such a broad uh, regulation which talks about sound basis, again not defined. So it gives a lot of scope for adjustments on related party transactions. And typically we do see a lot of, I mean, this is just the way multinationals work. We have a lot of costs coming in, a lot of related party transactions. Again, it's just reinforcing that point that to be aware of the probability or the possibility of those adjustments coming through in the assessment and allowing for any relevant provision. Of course, when it comes to arbitrary disallowances, we do get a lot of discussions with tax authorities. We do push back a lot. Unless it's codified, we feel that, and the cost is justified even through internal documentation. It is a genuine business cost related to Kuwait. And as long as you can support that, there are arguments at least to challenge any of the arbitrary disallowances to keep them as low as possible. But this is an area where, unless there's fixed or further clarifications or regulations issued, that we feel that this will continue to be an area of contention between tax authorities and the taxpayers.
Yeah, I agree with you, Fahim. I think this is where it depends on the documentation that what kind of cost is allocated and is it essential for the project or contract going on in Kuwait. So a lot of factors involved in this that while discussing and negotiating with tax authorities. Ms. Pavek, can we move to next slide on this? Yeah, this executive rule specifically talk about sale of shares in Kuwaiti entities only, as we highlighted in our previous sessions that we don't have a separate capital gain regime in Kuwait. So capital gains are basically taxed on normal business profits at 15% tax rates. So in this executive rule, actually, they are specifically talking about what kind of documentation will be required if a company, a foreign company specifically, is selling a share in a Kuwaiti entity. So if companies disposing the shares in Kuwaiti companies, then there will be a requirement of share purchase agreement, and it should be attested by Ministry of Justice, which is requirement of tax authorities should be considered. Then any amendment on Article of Association of Kuwaiti entity to confirm that certain change of the shareholder will be required, or any documentation supporting that the sale of assets, and this is collected by the company, the new company who is uh, taking over the shareholders, will be required by the tax authorities. And the tax authorities, they also have a right to request the new owner to confirm that certain acquisition, that certain transactions happen, in order to confirm the materiality of the transaction and confirm the capital gains incurred on these transactions, which is very rare in Kuwait, frankly. But when this case arises, these are the requirements a foreign company should consider while finalizing the transaction of disposal of shares in a Kuwaiti company. The only risk which we feel that in which can be a practical challenge while finalizing the tax returns, that if these capital gains are not properly provided in the tax returns, the tax authorities may deem these capital gains and apply taxes on the certain capital gains based on the documentation they will be reviewing and confirmation they will be receiving from the new owner or acquirer of the shares. Um, the important point is, what if this transaction is between two related parties as part of goods structure, group structuring? So this is also important point, because sometimes the transaction is on the same value where, the related parties are not showing any capital gains on that. So in this case, there is a possibility that the tax authorities may again, see the sound basis of this transaction the transactions will again create a risk for taxpayer. I think for the sake of time, I think we have covered all this, but any questions you have related to this executive rules, feel free to contact us, send us email. So Fahim, I think for the sake of time, maybe we can take this forward, please.
Yeah, absolutely. I think it's been a great, there's been a lot of detail, of course, and we expect, to have more questions come through. We've tried to answer what we can during the session. We are conscious that time is up. So those that we have not been able to respond to, I think we'll be in touch. And
Yep.
thank you for your participation. I think, Misbah, you can show the last slide where we've got links to our publications and the event feedback. So please, we'll keep this up for the next few minutes. And please go ahead and give us the feedback. Also look at our doing business in Kuwait guide, which is available. And again, we have options to ask questions through online forms as well. So we hope that you've found this interesting, and we look forward to seeing you in our next seminar. Were there any closing comments as well?
Yeah, two closing comments. And again, thank you for everyone again for joining us. And two comments. One is obviously you would have seen in the news the Dubai tax, the corporate tax coming in the UAE. So KPMG, Middle East and South Asia. And of course, I think we are part of that cluster. So in Dubai, we are in May also going to have an in-person Middle East and South Asia tax conference. So I think we'll provide the details to all our the group members here. Obviously, if you are in Dubai, potentially, I think you'll hear from us because I think whilst we're covering the Kuwait tax, I think that's a big change in Dubai, and a lot of the entities, the U entities also do business in Kuwait. So I think that would be an interesting one. What will happen to the overall? So if you're booking your profits in a Dubai entity from Kuwait, I think there needs to be a discussion there. Um, so I think, yeah, things will become clear when the law comes out. But that's an area that we'll pick up in May and obviously next year as well. So a lot happening in tax, but again, with this message, I think I'm sure that we're going to see you and speak to you again on our upcoming webinars, and hopefully we'll engage with you on these aspects. So again, thank you. Take care. Bye-bye.